Happy New Year, Unrivaled Nation. I hope it's healthy and prosperous for you as well. My name is Daniel. You're watching Unrivaled Investing. I've gotten a lot of questions about the Magnificent Seven, which did tremendously well in 2023. And a lot of folks are wondering, Daniel, what's your take on their performance in 2024? For those that aren't familiar, the Magnificent Seven includes Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta Platforms, or formerly Facebook, as well as Tesla. The lowest performer of 2023 of this Magnificent Seven was Apple, which was up nearly 50%. You look at Nvidia, and that was up over 200%. So between 50% and 200%, this was a fantastic basket to own last year. Typically, when I'm doing an analysis on a stock, I'm generally more focused on the individual stock, analyzing in detail what's going on. This is more of a high level understanding the forest versus, the details of the tree. And so it is important to have that perspective. Also, this is not financial advice. Very important for you to understand. When I look at Apple stock, I see the price to earnings ratio. This is on AI Ticker Chat. A lot of this fundamental charts that you're going to see in this video are actually completely free to use. So check that out yourself. It does have, AI Ticker Chat does have premium features where it uses AI intelligence to analyze stocks, and you'll see the AI predict feature. I will talk about that in this video, but AI Ticker Chat has a lot of historical fundamental data, including insider transactions, transcripts. That's all available for free. So check that out if you're interested. But looking at the fundamentals, like a price to earnings ratio for Apple, a key valuation metric, it does, give me a little pause seeing that it's near, what looks to be a very high level on a historic basis, around 30 times earnings for a business where for the last 4 quarters, the revenue has been declining. So you really do need to see a success with either a refreshed cycle in terms of their products or success with an AR/VR product that they're clearly working on and talking about. When I check in with AI Ticker Chat's predict feature, thinking about what it could perform and how Apple could perform in the future, looking at, future revenue, future profit margins, future end multiples, it's not that compelling, partly because this growth, it's been declining recently. And so if you really are a believer in Apple stock, you either need to say, hey, I would buy more at a lower valuation, or I think the growth is going to reaccelerate in a way that's really not anticipated right now. So that way, maybe you're getting back to, let's say, 10% growth in the future. That's the only way to really pencil out an attractive return in the years ahead when we're looking at Apple. When we jump to Microsoft, it's very impressive. The reacceleration in their sales, their sales growth had dipped to negligible a few quarters ago. Now it's back above 10% in the most recent quarter. And you're also looking at a business that just executes. You're looking at, this is their chart of historic profit margins. You see near historic operating margins. This is just incredible to see them just squeeze the profit out of this. And it's also highly diversified, unlike Apple, where you'd say, hey, if they lost the iPhone, they would be in big problem. It would be a disaster for Apple. You look at Microsoft, and there's just a lot of businesses that are doing really well. Microsoft Cloud, Office 365, LinkedIn, Azure. They talk about how they're gaining share in their various different cloud offerings, partly because of their partnership with OpenAI and their AI solutions. You see Xbox, 13% growth. So you're seeing very reasonable growth in the most recent quarter. That's broad-based. That's what I like to see. I also, during the crisis that happened at OpenAI, where Sam Altman was going to get cut out, got to give a lot of credit to Satya Nadella. He was effectively saying, let's make it work. Let's dance. Let's figure it out a way. And at one point, it was even bringing on the employees of OpenAI to Microsoft. So that flexibility and the fact that he could react so quickly does just give him such high marks in my book. So I like Microsoft broadly. When I, run it through AI Ticker Chat to think about the framework, it's very reasonable, in my opinion, looking at this, saying that, if they're able to maintain profit margins or even slightly lower than where they currently are, as well as post single digit and possibly low teens growth, then you can possibly have an adequate return over time, talking about, maybe 20 to 100% upside over the next few years, in addition to some cash accrual that's going to, go to the shareholders as either the cash builds up on the balance sheet or they buy back stocks. So that's another 2-3% a year that would benefit shareholders. The main concern is, could you have valuation contraction? And I'll talk about that in just a second, because valuation expansion was a key part of what we saw in 2023. So looking at Alphabet, jumping to Alphabet, their profit margins, had been contracting quarter after quarter after quarter. So I'm glad to see them taking, profits seriously. I'm curious to see what their fourth quarter looks like, but this might suggest, that they found religion in addition to recent headlines like, hey, we're going to lay off 30,000 employees because of AI and innovations. I'm curious to see how this plays out for the economy, how this plays out for their margins. But I look at Alphabet. I personally own a very small stake in Alphabet. And I think that there's a lot of uncertainty here. One of which, for example, is you've seen it through lawsuits where, Alphabet has historically paid Apple tens of billions of dollars to have their prime position, and to say, hey, we want to make sure our search bar is a default. And I suspect that changes in the years ahead. I suspect also with lawsuits with the Alphabet or the Google Play Store and the Apple App Store, I think the margins that they're going to get over time, that's also going to get squeezed. Historically, that's been like a toll booth where you get 30% off of every sale that's going through the App Store. I think that's also going to change. So I'm just looking at Alphabet, and I own it because it's historically been one of the most beautiful business models, but I also look at it and there's a lot of uncertainty. Some folks have talked about the death of search. I think that might be premature, but I do suspect that there's going to be a lot of changes with how consumers search. I personally have been using search a lot less and have been using, OpenAI solutions with ChatGPT 4. And I suspect you're going to start seeing some tweaks. Now, Google's saying, hey, we're launching Bard and we have, some Bard Ultra and some improvement Gemini Ultra that's going to come on, next year. It's just unclear how does this all flow through their profits as well, because running a search historically, is a lot higher margin than one of these generative AI searches or prompts. So it's unclear how this business model shakes out. That said, they are one of the pioneers in AI, so that's part of the reason why I own them. Once again, running it through AI ticker chat, it does suggest that if they're able to maintain, let's say, high single digit to teens growth and continued profit margin expansion, that the stock could perform well over time. But similar to what we're going to talk about with Meta in just a second, this is still, even though there's a lot of coals in the fire that can drive this business, it is still, 80-90% plus advertising. So if there is a recession, that will have a harder impact on something like Alphabet than it would on a Microsoft. So that is important to understand when you're thinking about the different risks looking at these different companies, is that an advertising business is more sensitive than, let's say, a requirement like a productivity software that you have with Microsoft or cloud solutions. Looking at Amazon, this is just an amazing story. I mean, just look at this revenue chart over time. This is exactly what you want to see. You see the seasonality, each year it ticks up with the holiday season. Operating margins, this is the one area where investors would love to see some improvement. And you've seen this sort of religious moment over the last 3 quarters where they said, okay, we're going to go from low single digit profit margins to improving our profit margin story. So the question is, can this continue to go higher in the quarters ahead? Let's say get to a teens type of margin. They have a large advertising business that might be able to justify a much higher margin. When I run it through AI ticker chat, thinking about, how does this perform over time using its AI predict feature? Once again, first month is free if you use the code below. I'm looking at this and it's really saying, well, it depends on how you think about the operating margins. If you're going to be stuck to closer to its average, then it might not be that compelling. But if you're in a territory, a future where their margins could be higher than what they've recently done or just stays at where they recently done, it just really depends on how do the margins shake out. If you're now talking about a company that's 10 to 15% margins, I think it's a very different story than what it's historically been. So that's really the question. Can you see Amazon continue to show that profitability improvement? I look at Nvidia and this is just an incredible story, up over 200% last year. So that means you've gone from a market cap of around $300 billion to, 1.1, $1.2 trillion. So that is tremendous amount of value that the market is assigning to Nvidia, partly because, you don't see graphs like this. This is very abnormal where you see, revenue growth, revenue deceleration, some negative, and then usually it sort of starts picking up and you see another cycle like you did previously in terms of revenue growth. You don't typically see this, we went from negative 13% to over 100%, then over 200% revenue growth. And that's partly because their GPUs are so critical for this AI revolution. So there's a shortage of their GPUs. So everyone's just trying to get their hands on them as they try to build the next iteration of AI. So I look at Nvidia and I like what they're doing in terms of empowering AI, but it does make me wonder, if this growth sort of resets, because you say, hey, we've reached maybe a new plateau in terms of how many GPUs we're going to be selling. And it's not about, hey, can we double this in the next year or two? I don't know. It's unclear to me, but this change, this inflection from, in terms of revenue and free cash flow, you could see the last two quarters of free cash flow outpaced what they did in some years, going back for several years. So this has been a step change in terms of their business, in terms of this AI demand, seeing it. So running it through AI Ticker Chat, thinking about its framework in the years ahead, it really just depends on, do you believe that this growth is going to be at such a high clip in the years ahead? In the high case, it's assuming 45% growth in the years ahead. I'm more cautious on that, partly because, it's unclear. Is this everyone just trying to get their hands on their GPUs, and then you'll see growth flatten out a bit or reach a new stable plateau? Because keep in mind, you could have growth flatten out to, let's say, 10% a year, and that would still be like record demand relative to where it's been for several years. So I just wonder if they've experienced a step change, and now it's going to just go slightly, the growth rate will be a lot lower. And if that growth rate's a lot lower, then I'd argue Nvidia stock wouldn't perform as well as what you're seeing here. So this is, including the latest data, which is, saying, hey, this company is growing very quickly. Could it decelerate significantly in the quarters ahead? I think it absolutely could. Jumping to Meta, I look at Meta stock, and the core fundamentals of the business continue to improve. And that is, when you think about this business, it's the users. If you have users leaving the platform, that would be like a sword in the gut for this business. You need to make sure the users are staying on the platform. As long as the users are happy and more users keep showing up, you look at the family daily active people across their various different apps, over 3 billion people using it. That's up from the prior year and up from the year before that. So this is what you'd want to see. And I'd argue their cost management has been improving. Last year you saw over $4 billion in losses in Reality Labs, and you see that they kept it somewhat under control over the last few quarters. Still, Mark Zuckerberg's comfort in terms of investing in AR and VR is just, it's a huge bet that he's making in terms of the metaverse, investing tens of billions of dollars in something that really isn't generating much revenue. So he's making a bet that eventually, or Reality Labs is just a couple $100 million, you can see here. It's not there yet, but it's possible that in the future they deliver. This is really an advertising company. So if there's a recession in the future, just like I called out with Alphabet, I think you could see some pressure. But looking at their recent growth, assuming they continue to execute, that once again, that assumes no recession. But if they're able to grow at a good clip in the years ahead, without a recession, growing at a teens rate, showing their recent profitability, showing a market multiple or a premium, then you could have a continued attractive return for Meta. But once again, you're very sensitive to the economy, given that this is still really an advertising business. That said, they have shown dramatic improvement in their profitability. And, it is important to call that out because, previously they were doing, in my opinion, some serious missteps where you saw this huge buyback at record stock prices, and then as the stock price collapsed, their buyback shrunk dramatically, and that was a huge turnoff for me. That's also a red flag generally. But look, they for the folks that were buying Meta, good for you, and I think it's awesome that you've made some money on it. But it's this is still very much an advertising play, I'd argue. That said, they do have some really cool VR tech. I've seen some of their glasses, and I'm curious to see how it plays out. You are still making a bet on, on Zuckerberg, rationally deploying capital. As I mentioned earlier, I wasn't happy with what they did with some of the buybacks where they cut it back. The buybacks they shrunk their buybacks as the stock price collapsed. Looking at Tesla, I just did a video on Tesla actually, so you can check that out for greater detail. But, the short summary is that Elon Musk thinks that the stock price or the value of Tesla could be worth more than Apple and Aramco, which would suggest over a $5 trillion valuation versus, let's say, an $800 billion market cap for Tesla. This is as of a tweet just from a few days ago, December 29th. So that prior video went into some detail, but my general takeaway is that I'm actually cautious. Very similar to advertising models, is that if you're looking at, auto manufacturers, they're going to be even more sensitive to, a recession. Also, a quick plug, take charge of your investment journey with unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for premium annual subscribers. I think it's super important just to go back to basics, and I'm going to do, a letter about this this week that should come out tomorrow for my subscribers, which is that, some of the best performers, some of the best investors over time, they focus on the fundamentals, and the fundamentals oftentimes, what's your free cash flow yield? And, so you're thinking about what's your growth, what's your cash flow yield, and thinking about the valuation, where if you pay a reasonable enough valuation, you're not even thinking about the valuation expansion over time. You're just thinking about what's that free cash flow that you can get as a shareholder. And you may not even need to own the most sexy businesses over time. You can own, something that sells, equipment for kitchens, or maybe it's, a sensors business. So so I'm going to talk about that in greater detail in this week's exclusive letter to my subscribers at unrivaledinvesting.com, particularly calling out this one investor who's generated a 20% annualized return for, over a decade now, just focusing on these types of companies that are, focusing on what's the free cash flow yield. Is it generating reasonable growth, and what's that sort of runway in the years ahead to think about the returns? I hope this video providing a high-level overview of the Magnificent Seven has been helpful. Personally, when I look at the Magnificent Seven, I don't own, I only own one of them in a small size. I'm focusing on other smaller plays where I can have higher conviction. Maybe there's a lot more insider ownership, or, there's easier stories for me, which I discuss at Unrivaled Investing. I hope this video has been helpful for you. Thanks so much for tuning in.